Hello everyone, my name is Anisya Putri Rahma Wati from Class Act 23A. Here I will explain about investing in equity instruments is a significant topic in advanced financial accounting, as it involves not only the acquisition of ownership interests in other companies but also the appropriate classification, recognition, measurement, and reporting of such investments in accordance with applicable financial reporting standards. Equity instruments refer to financial instruments that evidence a residual interest in the assets of an entity after deducting all liabilities. Common examples include ordinary shares, preference shares, when classified as equity, share warrants, and ownership interests in partnerships or joint ventures. The motivation behind investing in equity instruments varies across entities. Some investors may aim for short-term profits through active trading, while others pursue long-term capital appreciation or strategic influence over the investee. From an accounting perspective, investments in equity instruments are recognized and measured in accordance with PSAK 71, which adopts the principles of IFRS 9. Upon initial recognition, equity instruments are measured at fair value, and subsequently, entities must classify them into one of two categories: fair value through profit or loss, FVTPL, or fair value through other comprehensive income, FVOC. The default classification is FVTPL, under which all changes in fair value, including realized and unrealized gains or losses, are recognized in the income statement. This category is typically used for equity investments held for trading or speculative purposes. Alternatively, if the investment is not held for trading and the investor intends to hold the equity instrument for long-term strategic purposes, the investor may make an irrevocable election at the time of acquisition to classify the instrument as FVOC. Under this classification, changes in fair value are reported in other comprehensive income and are not recycled to profit or loss upon the sale of the investment. However, dividends from equity instruments classified under either category are generally recognized in profit or loss when the entity's right to receive the dividend is established, provided that such dividends are not considered a recovery of part of the investment. Furthermore, unlike debt instruments, equity investments are not subject to the expected credit loss model. As a result, impairment testing is not applied in the same manner, and any fair value reductions are reflected through the designated fair value pathway. Equity investments are derecognized when the investor no longer has control over the rights associated with the instrument, which typically occurs upon disposal or transfer. Any resulting gain or loss from derecognition is accounted for based on the classification, through profit or loss if FVTPL, or retained in other comprehensive income if FVOC. In situations where the investor holds a significant portion of voting rights, typically 20% or more, this indicates significant influence, and the investment is no longer treated as a passive financial asset. Instead, it is accounted for under the equity method in accordance with PSAK 15, IAS 28. Under this approach, the investor recognizes its share of the investee's net income or loss in its own profit or loss and adjusts the carrying amount of the investment accordingly. This method more accurately reflects the investor's participation in the economic activities and performance of the investee. The decision between applying fair value measurement and the equity method depends on both the level of ownership and the nature of the investor-investee relationship. In practice, investing in equity instruments presents various accounting challenges, including determining fair value for unlisted securities, assessing whether dividends are income or capital recovery, and distinguishing passive investments from those with significant influence. Proper classification and treatment are critical, as they directly affect the presentation of financial position, performance, and equity in the financial statements. Mastery of this topic enables students and professionals to make informed financial decisions, conduct accurate reporting, and uphold the reliability and transparency of financial information in accordance with international accounting standards.